Welcome to DeFi by Design, where we talk all things blockchain and cryptocurrency while striving to educate, empower, and enrich.
What's going on, guys? Real quick break for the DeFi by Design podcast sponsors and the DeFi Slate sponsors who make this all possible. First, we have 𝗵𝗶𝗴𝗵, a money market protocol that allows you to borrow and lend and leverage your assets to earn interest, right? So if you want to deposit some stable coins in there, currently you can get 3, 4, 5, 6, 8% APYs on stable coins, which oust any bank in the world. As far as we're concerned, you can deposit any Ethereum-based asset that is listed there, borrow against it. You can borrow stablecoins. You can borrow other assets like ETH or 𝗹𝗶, Link, even the 𝗵𝗶 token itself. 𝗵𝗶 is the go-to protocol for any sort of borrowing and lending. Check it out at app.𝗵𝗶.com. The next one we have is 𝗃𝗃𝗃. 𝗃𝗃𝗃 is a new crypto wallet, 𝗃𝗃𝗃.com. You can store all of your crypto there. They have quite a few options. They're integrating new DEX features soon and allow you to have a non-custodial way to store your crypto safely off of centralized exchanges and also just not in a MetaMask or in your own ledger. A bit of extra security there. Next, we have 𝗵𝗵𝗃. 𝗵𝗵𝗃 is a decentralized perpetual swap protocol, basically allowing you to trade on leverage on the Ethereum chain, right? They're coming out with V3 very soon. By the time you're listening to this, it might already be out. They are a super solid team, and they're pumping updates and allowing you to trade decentralized perpetual swaps on ETH, Link, and a few others, all on Ethereum, all decentralized. So that is 𝗵𝗵𝗃. Next, we have 𝗵𝗶𝗴𝗵. 𝗵𝗶𝗴 is a decentralized stablecoin. It's an algorithmic stablecoin that is pegged to the purchasing power of commodities. And then basically, it measures what value $1 buys in terms of a commodity index each week. And then it provides you with essentially a store of value that allows you to continuously evade inflation while maintaining, a stable aspect as if it was $1. And that is the 𝗵𝗶𝗴 protocol. Check them out on Twitter. Finally, we have DiversiFi. It is an L2 decentralized exchange. They allow you to basically trade in a gasless and feeless manner, big volumes, whatever quantities you need. It's almost like a centralized exchange on Ethereum, but you are the custodian. They do not hold your coins as a centralized exchange would. You have full control, full power. So really, it's almost like a centralized exchange capabilities on a decentralized exchange, and that is DiversiFi. All those sponsors make this possible. I know it's a lot to take in, but thank you very much for listening, and let's get back to it. Howdy, good morning, y'all. We are here today. It is, as Robbie says every single time, a beautiful day here in Florida. Wow, what a surprise. No, I'm kidding, guys. Good morning. We are live right now. This will be out in just a few days, so it'll be live for you. We are here today with Hugh from Nexus Mutual. Been interested in this project for months now. Been kind of learning about insurance throughout this whole thing. Wouldn't you say, Robbie? Like, we didn't even know what DeFi insurance really was, and then now all of a sudden it's something that's been brought to our attention.
Yeah. I mean, what's up, guys? It's day after St. Patty's Day. I hope everyone had fun last night. But like Andy's saying, insurance is the new wave when it comes to DeFi. Obviously, crypto, right, about 10 years old. DeFi, call it 3 years max. And the world of insurance in DeFi, probably only a year or two old, right? So definitely bleeding edge technology here. Super interesting stuff. Honestly, if someone, even, after you learn about crypto a little bit, if someone mentions insurance along with crypto on the blockchain, you're like, maybe you think about it a little bit, but the implementation just sounds difficult and not really sure how that would even work. But Nexus Mutual certainly, has their approach and is figuring it out. So we got Hugh here.
Yeah, it's all about safety, Rob. I don't mean to interrupt so early, but it's all about safety. Hugh will tell you after the hack. Hugh.
Yeah. Hugh, why don't you go ahead and introduce yourself and kind of dive right into kind of what's going on with Nexus Mutual and how you got to the point where you're at now.
Yeah, cool. No, thanks for having me on, guys. So I'm 𝗵𝗵𝗃𝗃. I'm the founder of Nexus Mutual. Little bit of quick background on myself. I'm an insurance professional by background. Been doing insurance for quite a while now, 15 years. Studied actuarial science. I'm an actuary. Worked in Australia 10 years and then moved to London and worked in big reinsurance companies for a while before kind of starting Nexus. I guess what we're really trying to do is take insurance all the way back to its roots. So like so many years ago, like millennia ago, you had like different communities banding together to share risks with each other, and essentially that's how insurance starts, like just a group of people sharing risk. And now we have this really great new technology that allows people to coordinate on a financial basis in a lot more effective and scalable way. And so if we can construct the right incentive mechanisms, then we can share risk together without the need for an insurance company. So that's kind of what we're trying to do, what we're trying to recreate. And I guess from a more specific like crypto point of view, our early users are obviously going to be crypto natives, and so we wanted to build a product specifically for them. And the most obvious risk that we could think of when in the crypto space is smart contract risk. And I think that kind of came about primarily because in 2016, I watched the Dow be drained alive. I was watching the blockchain with all the money flowing out, transaction by transaction, going, this is a massive moment for the whole ecosystem, and if we're ever going to be successful, we have to protect against these types of risks. So that's kind of where the genesis of the idea came about. And yeah, we've been building and selling cover for a while since then.
Nice. Yeah, that's an interesting background. I remember earlier we were talking about your journey through Australia and kind of how that's where you grew up and went to school. Which it's interesting to see how the school and the area that you've grown up in is completely different than us, but we are still able to be here working, as you said, this entire message of shared risk, shared responsibility. This world is becoming globally shared, globally connected. And we're happy that you're here. Let's go into safety, Rob. So 𝗷𝗶 has a motto or slogan: safety is sexy. In DeFi, safety is sexy. Mark Zeller will tell you that. He's an absolute clown. Love that guy. And Robbie, what do you think?
Yeah. I mean, safety is definitely sexy when it comes to crypto, right? Like, you want to make sure that not only you have potential to grow, right? That's certainly something that is fueling a lot of the speculation and a lot of just a lot of the money and interest that's pouring into crypto. But at the same time, with all of that collective hype and attention that's being put towards crypto, you have a lot of risk, right? And Nexus Mutual is taking the approach where we can share that risk, and it doesn't just fall on the people that are coming in and taking on a speculative approach to these projects with high APYs.
Come on, guys! Like exactly, like it's risk and speculation to the max. Like the world is hooked on it. Hugh, I'm curious, kind of what your mental model of all this is with safety, right? Like, what does this kind of mean to you, and how do you like see that, right? Like, how do you see the vision of a safe DeFi? Like, what does it mean to you?
This is just a new industry. I mean, just a new industry. I think it's a fantastic industry, but it's essentially a new economic industry. And like we had shipping before, we've had space exploration, we've had a whole like railways. We've like all throughout history, we've had like new economies and industries spring up, and they generally go out into the Wild West a bit before, but then before long, everyone to kind of scale up and grow, you actually need an insurance layer. And that kind of spurs economic activity, because that means more people can actually take on business risk when they know that they can offload the risks that they can't handle. So for any economy to grow, there needs to be basic financial infrastructure, and insurance is one of those things. Like no one sends a rocket without insurance. So that they wouldn't get off the ground and stuff. And so right now we're a whole bunch of little explorers going out there in the Wild West ourselves, but as soon as we want to get more mainstream adoption and more serious players, especially if they're more risk aware, they're going to have to tick those compliancy type boxes, and they're going to need these types of solutions before they enter. So it may they say this insurance is sexy, but it's kind of it just kind of has to be fundamentally there, and stuff to kind of get adoption happening, and so that's kind of what we think we're providing as a big kind of service for the whole industry.
And Andy mentioned kind of your journey through Australia, and you went to university there. Maybe you could take us through that journey. How once you graduated, you started working in insurance, and then that really opened the world and then how you found the bridge between that traditional insurance world and one that can exist in crypto.
Yeah, so I think so basically, started working for various life insurance companies in Australia, in Sydney.
Real quick, Hugh, I don't mean to interrupt in the very beginning of the story, but life insurance, like, do you mind if I ask, do you have that? Like, is that advisable for young kids like Robbie and I? Just as a smarter, older guy, like, I'm curious. Like, real quick.
Yeah, look, I mean, not a financial advisor, all that stuff, but if you die, if there's someone that's dependent on you, or you have that someone, if you've got a kid, or if you've got a spouse or something like that, or you've got a debt that's going to be passed on to someone else, like, that type of stuff, then it makes sense. But if you kind of just by yourself, if something happens, then that's kind of it. There's no real kind of follow-on consequences, and you probably don't need this stuff. But it's fundamental for a lot of people. So yeah, I guess one of the interesting things about life insurance, though, is, which is very different to DeFi, is that I spent my life growing up doing financial projections over 80 plus years, like basically making sure we've got enough reserves as an insurance company to pay out future claims on a time frame that was longer than I was going to be alive. And whereas DeFi is where am I getting my yield from tomorrow? So it's kind of like this total different end of the spectrum. And I think I have a bit of a I'm definitely much more longer term focused on things and making sure that we build things properly and around there to be there to pay the claims and all that type of stuff. So it's definitely a bit of a challenge being in there with all of the apes and the degens doing their thing.
Yeah. And is that different than when you started? Robbie was kind of getting at this, like what's the bridge between the two industries, like through your experience, for folks who are in insurance or not? I mean, it's definitely like, it seems different, but it's also so similar, I suppose.
Yeah, so I guess the bridge was like I kind of went down the Bitcoin rabbit hole 2010, 2011, and I didn't really know what I was doing there, but I got really interested in the tech because it fascinated me in terms of being able to send money without anyone else in the middle. And so I was always kind of keeping an eye on things and stuff, and but I did put it down for a bit, and I kind of got back into it once I heard about Ethereum. And I think I guess the other element is I got a bit jaded with my time at one of the big reinsurance companies in Munich Re. We were doing a lot of good stuff, but we were essentially shifting big amounts of money around balance sheets, doing capital arbitrage. Fundamentally, that's what it came down to. And I felt that was a bit too far from the end user, and I felt I wanted a bit more purpose in there. And when connecting that with Ethereum, it was like, oh wow, I can actually just to take this whole chunky machine out and in just like the whole insurance machine of everything and connecting each other, and just replace it with some code, and we can just connect together as individuals. Because when it comes down to it, insurance is a very social, community focused piece of like technology, or I guess skill that humans have. Like, it's all about sharing risk together, and the infrastructure and everything that we've put in place to industrialize insurance over the centuries is just been a way of more efficiently doing that. But now we have a new tech that can actually fundamentally coordinate us at the base level, and we don't need all of that other stuff. So that's kind of the journey and the thought process and stuff that went behind it.
Yeah, and you mentioned the Dow hack that happened back in, I think it was 2016, when Ethereum was launching this glimmering, shining product. It was supposed to be a game changer, the Dow, right? Like, not just a Dow, but it was the Dow. And as soon as they pressed go, all that money got sucked out and just drained. Obviously, there was tumultuous consequences that resulted from that. Born was Ethereum Classic, right? And there was a lot that followed. Let's pretend Nexus Mutual was in existence back then when Ethereum and the Dow got hacked. Could that have been prevented? What could have been the steps that were taken if there was an insurance layer on Ethereum way back in the day when Ethereum had the DAO that was drained.
I mean, ideally, if something like that happened and people had some cover, then they could simply just make a claim based on how much they lost, and they could get refunded, essentially. And that's kind of how our first product, smart contract cover, was. That's specifically what it was designed to cover against. I guess it's kind of funny that we designed smart contract cover when basically the hacks that we'd seen were the DAO and the two parity multi-sig wallet issues, and a few others that were, but basically that's when we were designing our product at that point. There's obviously been a myriad of extra additional types of exploits, and things have just, ballooned with different protocols, different integrations, flash loans, a whole bunch of other things, right?
You got hacked, Hugh.
I did. Well, yeah, there is that as well. That's perhaps a bit different, but yeah. But there's obviously keeping your private key safe as well, which is like up to individuals and stuff. So, the risk is kind of ever present with everything we're doing here, like everyone in crypto, and the outside world kind of knows that as well. So, they're definitely aware of it.
Yeah. So maybe this is a good transition into kind of more on the Nexus Mutual side rather than your personal side of things. You guys were able to look at the past hacks. There was the two big ones, the DAO and the parity multi-sig hack, and really model the product after protecting against those types of attacks. Now that DeFi has evolved quite a bit, there's much more complex hacks that are happening, as well as personal attacks. How has Nexus Mutual evolved their own product, your guys' product, with the complexity in those layers that are now being built up to protect against these more sophisticated attacks?
Yeah, I think obviously things are developing, and the variety of different attacks is widening. So I guess the one really concrete thing is, right now we've actually got a vote in our governance system that people are voting on at the moment to upgrade smart contract cover to what we're calling protocol cover. And so instead of, at the moment, smart contract cover covers against bugs in the smart contracts, pretty much. And the protocol cover will cover a wider variety of events. It will cover everything that smart contract cover does, plus Oracle attacks, governance attacks, and economic attacks as well, like kind of on the severe end of the economic attack spectrum. So it's definitely a lot wider. It also will cover. It also gives us the capability to cover smart contracts running on any chain, so not just Ethereum. And it allows us to also cover layer 2 systems as well. So it's a very big upgrade in terms of the potential risk coverage that's available there, and it's definitely a response to how the ecosystem is developing.
Yeah. Okay, so this is definitely a big upgrade, and we can dive into some more of what this means as the insurance layer pretty much go to for the ecosystem. I have kind of a specific question. I'm really curious what an insurance on a governance attack looks like. Right? To me, it's like, if a governance, votes in a certain direction, it's like, well, that was a vote, and that's kind of the direction you guys take. But what are some of the mechanisms to protect against, well, first, I guess, what is a governance attack? And then what are the measures to protect against one?
Yeah, so I guess both the governance and attack and probably the economic attack fall into this kind of spectrum. What we're doing is we're designing the product to cover the more extreme end of the events. So with the governance attack, the kind of criteria is basically, one, the protocol is governed by a governance token and can be upgraded by token holders. So there is a governance system in place, rather than it just being held or controlled by a multi-sig. So we don't cover the rug pull scenario. That's very specific. The second thing is that they gain control of the system via the governance processes, and then they alter the system to basically steal funds from regular users. So they take liquidity, or they take collateral, etc. So not just that they've changed a parameter and the system still operates, more that they've maliciously attacked this thing and taken people's money against the original design of the system.
Almost like a 51% attack.
Yeah, or like a Cybele attack. Is that a term for that? a symbol?
Yeah, it could be that as well. I mean, that's obviously we didn't quite use that term, but basically, someone gets control of the system and drains it, upgrades it in a very malicious fashion.
Yeah, but there could never be a scenario where you covered rug pulls too, because then there would be people who just rug pull on purpose to game the system, and it's just a big game of chess, and it's like, come on, guys.
The game theory behind it all is awesome. I'm a math and philosophy major, where I go to school. So they don't have a game theory major here, but like if there was one, I feel like it would kind of be the intersection of what I'm studying. So I find all this stuff really interesting.
Yeah, I think I played Magic the Gathering for many years, and that's a lot of strategy and stuff like that. And in a weird way, I think that's set me up reasonably well to think about all of these different kind of attack vectors and stuff. You're very just operating in that totally adversarial environment. But I think I think this is basically something that we need. I guess on the rug pull in particular, yes, totally agree. It's an uninsurable event in my mind. It's like you can't insure someone's private keys because I'll just double my money. You give that insurance to me, I'll double my money. And so, it's that there's sort of some things we can't quite do right now, but there are definitely stuff that we can do and make it a lot safer for a whole bunch of people.
Yeah, on the game theory side, it makes you think about kind of how everything in crypto is created, because you have to think of all these, things that could happen effectively and run all the numbers through and then find the end product and then keep improving that based off new things that happen while incorporating all those new events into what's already happened in the past and the current product, if you will. I'm curious, in that kind of train of thought, what is the 0 to 1 improvement for crypto wallets that you could foresee? Right, we've got the seed phrases, we've got the social recovery, we've got the passwords, we've got the like the YubiKeys and the two-factor and stuff, But I guess you can't tell the future. But what's next? What's better?
Yeah, I mean, I think there's a lot of people iterating on this stuff, and we'll get to a good solution. I actually think there's a way of making a recoverable plus insurable crypto wallet, and like that would be kind of designed with a recovery process in place, and probably under a time lock. If you don't actually insure the private keys, but you insure the recovery agent against failure. So it's kind of like a business. So you have a service provider being the recovery agent that can restore your wallet if you lose your keys. But then if they fail, then you've got an issue, so you can insure that. So that type of approach, I think, can work quite well for the self-custody segment, which, to me, that's what we should all be trying to encourage.
Yeah. And now that we're getting back to kind of the personal security aspect, I'm interested, if maybe you could just, without going into too much detail, whatever you feel comfortable with, the attack on your wallet, kind of take us through what happened, why it happened, as much as you can understand, and some of the preventative measures that going forward, can stop something like that from happening again.
Yeah, cool. Happy to. So I think I guess the first thing is that I was operating a hardware wallet through MetaMask, and my private keys were never breached. So I still got full control of the private keys. So what actually happened was I basically opened a malicious docx file that was very highly targeted, because it had a title of a particular topic that we were talking about in our Discord at the point in time. So I guess the point being, the hackers are frequenting Discords and doing highly targeted emails. So it was a spoof email from one of my teammates to me with a docx file with a heading that was a specific topic we were talking about. Anyway, opened it. At that point, they've compromised my computer and they've compromised my MetaMask. That's all fine to a certain extent, because I've still got my private keys in the hardware wallet. That's okay. And then at some later point in time, they've deployed the malicious MetaMask extension. And what that has done is, instead of when I go to just do a normal transaction, like I was claiming some rewards, it has replaced that transaction and with me to send them a lot of NXM tokens. And so I approved it on MetaMask because that looks okay. It goes to the hardware wallet. You can't see what the detail is because it's just hashes. And so I just click through and approve. So basically I've approved, it's a spear phishing attack or a spoof attack where I've approved something that I should never approve. So so the problem is with me not double checking that what I'm approving on the hardware wallet is actually what I thought I was approving on MetaMask. So so it was basically one transaction that I shouldn't have approved. That's the trick. The things you can do, I guess one of the more important things is I'd use a separate computer that just signs transactions, doesn't do anything else, visits only a few websites that you need. No email, no social media, nothing else on that. And I guess the other thing is consider, make sure that you kind of know which to address you're supposed to be interacting with, which is often easier said than done. It's often quite difficult, but take your time and do that type of thing.
Real quick, you mean on like when you're scanning the ledger, like when you're checking the hash,
yep.
It shows you the contract address. Yeah.
Yeah, exactly. So basically, before you do a transaction, check the contract address you're supposed to be interacting with, look it up on Etherscan, and then go from there.
This is kind of what I meant though, like when I said like what's like the next best, because like that is still just like subpar. Like honestly, that's just subpar. Now, I'm not going to blame it on, it was, you took responsibility, but that's still, very subpar. Like, I mean, it works great, but.
Yeah, I agree. Like the lattice from Grid Plus is a good step in that direction. I haven't got one, but they have, it's a bigger hardware wallet that has a screen which gives you a lot more human readable information about the transaction that you're actually approving, rather than just a small screen on the ledger or whatever. So that's kind of one thing. I'm sure there are different other ones that are coming into it, but yeah, I'm quite paranoid and cautious now, but I take extra time and make sure I do it properly. So I totally agree that that's not for everyone, but that's what I do right now.
Yeah, and I mean it makes me think about, there's, I don't know, how many people would you say are capable of doing something like that on Solidity? They have the technical know-how, not only, I mean, basically just to create a malicious MetaMask software and integrate their own malicious transaction onto that. I'd say, I mean, it's got to be less than 1,000 people worldwide that have that technical know-how.
Yeah, these are sophisticated hacking groups that know exactly what they're doing.
Wow. Yeah, and it's interesting that, I mean, they're using their powers for evil instead of good.
It's like the in real life mafia. It's like, it's probably like you said, groups of people. There's probably several, honestly, probably hundreds, maybe. Yeah.
Look, I mean, I don't really know, but the point being that step one, like if the fact that they compromised my computer at that point, if you are just holding money on MetaMask, you're gone. So the fact that I was on the hardware wallet gave me another level of protection, but security is all about levels. You're never 100% secure, and there's always a route in. But you just have to find the right balance for how much money you have versus your UX versus your wished for security. So it's definitely a balance.
It's a never-ending journey.
Yeah. And on MetaMask, it said the transaction that you were trying to confirm, right? It didn't say anything about a different address or Nexus Mutual tokens at all.
Yeah, correct. Yeah, what it said on MetaMask was perfectly correct. Yeah. So that was the spoof.
Yeah, the hot wallet is dangerous, very convenient, but dangerous. I am not a crypto advisor, but for everybody who's listening, hot wallets are great for small amounts on cell phones, in my opinion, because, I mean, if my phone got stolen, it would be very unfortunate, or if I lost it, right? But if you don't keep a huge amount on your phone in a hot wallet that you can spend and you can do as you need, taking an L on that would suck. but it wouldn't corrupt your, let's say, savings accounts elsewhere. And kind of on that train of thought, Hugh, you don't have to tell us all your OPSEC, but like curious, like just one or two improvements aside from what you already said, like that, our listeners can do today to improve their security.
Yeah, I guess the separate computer one is a good one. I guess the other one is make sure you remove any infinite approvals that you don't need. There's a few websites that do that. And I think that's an interesting one, especially because some of the attack vectors on DeFi protocols have been like replaced with evil contract, and if you haven't got an infinite approval, then you're a lot better spot. So that's one thing. Good health on that one. And I guess there's always a million things, but that's probably two for now.
I remember I went back to one of those sites after I saw it on Twitter, like some, absolute gutter tier shitcoin farm that I was in summer was freaking out. Everybody was freaking out. So I was paying the gas for all of it. Like I was trying to figure out the website. It was like, there's 3 options. It was just like, oh my God. I was like, okay, I'm just going to go through a lot of these that just seem sketchy and just cut it off. But yeah, thank you for those 2 options. And I think that's a good start. And yeah, the improvement of the wallet experience is going to be a big thing that I think is going to be a 100 million or 100 Bitcoin, 100,000 coin industry. Literally, like whoever can do that and expand on that and just keep growing that is going to make so much money and help the community a lot. So I'm excited for those developments.
Yeah, and Andy, you hit on another thing that could definitely improve personal security is the disbursement of funds, right? Like in fiat currencies, traditional finance, we have checking accounts, savings accounts. If you're at that level, you have maybe a trust fund that has different beneficiaries and different signers. And that is now getting paralleled in the crypto world. Like you said, a little bit of money in a hot wallet on your phone, there's your checking account. That ledger or that 𝗬𝗵𝗵𝗃 with 2-factor and all of that, your hardware wallet, that's your savings account. And then you have a multi-sig where you can, delegate beneficiaries, signers, which can act as your trust fund once you start to accumulate that level of wealth. And kind of what Hugh mentioned about convenience, user experience, security, it reminds me of the trilemma that Vitalik mentions between scalability, right? You have these 3 things. You can really only pick 2 of them without sacrificing the other. So you kind of find like a centrist idea somewhere in the middle of all 3 where you're not sacrificing any one too much.
Hugh, is that a good narrative for us to kind of view the fundamental of security and of wallets and of kind of innovation in crypto? I'm wondering, there's a lot of fundamental talk and there's a lot of narrative talk. I'm kind of wondering where you align with I suppose, what Rob's saying as far as what we sacrifice for innovation and then what we can keep when it comes to safety.
Yeah, look, it's at the end of the day, different solutions are going to work better for different people. And I do like your approach, Rob, of like having, a small amount of cash in your, it's like cash in your wallet versus something in your, savings account or whatever, and then a trust or something like that. That kind of tiered approach makes complete sense. So that you kind of, if something goes wrong, you're less exposed. And other teams and more professional people and institutions are probably never likely to self-custody. And they're probably going to be trusting the big custody providers with their high-tech approaches, and that's going to be fine. But, I think we want kind of individuals to be able to interact with these systems and stuff. And so there's definitely a whole lot of people working on these problems. And, I think everyone's making good progress. There's definitely more to go, but we're definitely getting there and people are focusing on the right things.
Cool. Yeah. Let's bring it back to Nexus Mutual and kind of away from security, but more towards insurance. Obviously, those two are related and have a lot of overlap. But there's a lot of cool things happening on Nexus Mutual. Like you said, the big upgrade coming out. I'm interested. We talked kind of specifically about governance attacks and these different types of attacks. Kind of, what is Nexus Mutual's approach to protecting against these attacks away from a personal security standpoint? And what are some of the new features that are coming out on Nexus Mutual that these power users, these contributors can use as a functional way to either make money using Nexus Mutual or gain more security using some insurance cover?
Yeah, so I think most of the big updates we're pushing right now are definitely on the kind of end users end of the spectrum, where you can like just get coverage for a wider variety of risks and stuff like that. So I guess one thing a lot of people don't know is we actually already offer a cover for centralized exchanges for custody providers. So you can get cover on Binance and Coinbase and Kraken, Gemini, and also like Celsius and BlockFi and a few others like that, HODL as well. So so that's kind of we've got some different products out there, and I guess that's one thing that actually shows the kind of flexibility of the Nexus system. Like we can actually develop new products relatively quickly, and because we have this voting process on claims, we can effectively, that's our oracle, and so we can pull in information from the outside world. It doesn't have to be all on chain or whatever. So we can design products with triggers that, as long as we can assess whether they've happened or not, then that's okay. So so that's kind of, most of the focus has been on that angle in terms of the product and risk coverage side, especially with like this sudden explosion into deploying on other chains. Obviously layer 2 is coming soon, just starting, but it's going to be a big thing for the Ethereum ecosystem really soon. So we're kind of getting ahead of that curve in terms of the product to make it compatible that way. I guess on the other side of things, in terms of like members of Nexus and being able to kind of earn rewards and stuff like that, along with the current protocol cover that's in governance, we've also got another governance action happening right now, where you should be able to increase your kind of leverage as a staker from 10 to 15 times. And this will allow the stakers to earn more, take on more risk as well, but earn more and back more covers. So we have these stakers in Nexus can kind of specifically back risks. So they put their money behind like Compound or Uniswap or SushiSwap or whatever, different, they back the different protocols. And the more people that stake, the lower the price of cover and the more cover is available. So this is kind of giving people more capital efficiency on their staking, so they can stake 100 NXM and they can spread that across 15 different things rather than 10, and earn rewards on all of that. So that's kind of a pretty big change for the stakers, and that'll be quite good to get some extra fluidity into the staking system and stuff like that. So especially as we're growing wide. So one of the key things about insurance is actually diversification. So the mutual itself needs to back a whole bunch of different risks so that it can be diversified and is not overly exposed to any one risk itself, but carries lots of different risks. And in that way, it can actually be heavily under collateralized, and that's really key from an economic point of view, so that we...
Is that kind of going into your thought process about other chains and L2, in a sense, that's kind of a diversification?
Yeah, exactly. I mean, the mutual will work better the more diversified it is. That means it's more capital efficient. You can basically write, like at the moment, we're writing about 3 times as much risk as we have capital. So we've got gearing of 3 times, which sounds pretty cool, but AIG runs at 60. So we're on
faith in the teams over there, eh?
Oh yeah. But like the point being, like, insurance is massively under collateralized, and that's the whole point. It diversifies risk. If everything was to claim it once, no insurance company would ever be able to pay it all. But that's the whole point of what it does. That's the way it can offer cheap rates. So that's really key. So we're on our journey there, and diversification is a big part, and obviously being able to support different ecosystems, layer 2s, etc., is part of that.
Am I understanding the balance right, that as the gearing of insurance protocols goes up and we're able to write more insurance, thus being more under collateralized on the insurance layer, the over collateralization of investment products can go up? For example, like Aave, Compound, those types of projects that require over collateralization, that amount of collateral can go up as the gearing on the other side goes down, or gearing would go up, but collateralization would go down?
So not necessarily, mainly because 𝗹𝗲 and the collateralization ratios are specifically designed to address market risk movements rather than the risks that Nexus is taking, which is more technical failure type risk, which is independent of market risk. So the market risk buffers on 𝗹𝗲, etc., are basically so to prevent under-collateralization when the market moves quickly. And so the more volatile an asset, the bigger the buffer. And so they're different risks, so not necessarily. But I guess one thing that is potentially Nexus can provide is a protocol backstop to like 𝗹𝗲, for example, has a self-insurance layer, and some of that's backed by 𝗹𝗲 tokens. And so if there's an event, they will pay from the insurance fund and then potentially top it up by minting extra 𝗹𝗲 tokens and selling them on market. I guess one of the things that Nexus can do is provide a claim payment to the protocol at that time if there's a technical failure. And in that way, you can avoid some of the minting and burning of the token. So there's kind of a dampening effect on a big risk. So that's a different angle that Nexus could be used for. We currently don't do that right now, but that's an option.
That protocol kind of relationship and interworking is just going to be so key for composability and for growth in DeFi. Like, we've only scratched the surface of like what I consider B2B deals, if you will. Those are going to be crucial for the growth of the system. And just bringing us back real quick to kind of, Rob, what you were saying with the collateralization and the 𝗹𝗲, the way that I view it is a bit as Hugh was saying. Obviously, when you're putting your funds in 𝗹𝗲 as collateral, right, that is dependent on the market, not on if they get hacked. However, if you're borrowing stable coins and then you're going to put those stable coins into a farm at higher than what you're paying, and that farm is insured by Nexus, you could have a bit more risk tolerance in what you're doing with your loan than if there was no insurance on the loan at all. So obviously, you can't change what the price of Bitcoin and Ethereum and 𝗹𝗲 are, right? But you can choose to take your loan and go to a safe place.
I think that was a great way to explain it. Yeah, and it takes the market risk that you're taking on when you invest in a coin or you're in a farm, but that farm also is going to have a smart contract risk. And if you can have 𝗹𝗲 insure against the market risk with their collateralization mechanism, and you can have Nexus insure against a smart contract risk, you're able to share that risk. No one is taking on the bulk of it, and it kind of spreads it out thinly so that no one is taking on too much. Super cool stuff. And I agree, Andy. The B2B deals.
Yeah, I want to get more into that. That's dope. It's kind of stimulating. Like, what do you think, Rob? And I'd love to hear Hugh's mental model for what they're trying to do, like partnership wise, I suppose.
Yeah, I mean, collaboration is key, right? And decentralization breeds collaboration, which is it's, to me, is kind of revolutionary, because we're getting away from a competitive nature of business where competition, you want to outperform your competitors, you want to earn the majority of the market share, earn the most profit, understandably so. But now we're getting into a sense where, no, you actually want to share risk, spread it amongst the most amount of people, and diversify accordingly, so that no one protocol is taking on too much for the sake of the ecosystem as a whole.
So how does that happen, Hugh, in literal terms, in DeFi higher rankings hierarchy? CEO Hugh 𝗵𝗵𝗶𝗵 of the Nexus Mutuals. No, I'm kidding. But yeah, so how does that actually happen, right? Like, what happens with your partnerships? Like, what are some examples?
Yeah, I mean, there's lots going on there. I mean, in general, I think one of the things that's really interesting in this space is that we can turn games which are one person against the other into cooperative games really, really easily. And so I think that's really cool. In terms of like the partnerships and things, we've got a lot going on there. A lot of them are going to be around surrounding like just being able to easily buy cover at the point of sale, rather than go and put money in particular yield farm over here and then come over to buy Nexus, that type of thing. So a distribution place like that. But also that protocol to protocol type covers is definitely interesting. We put a proposal to 𝗵𝗶𝗴𝗵 late last year about that specifically, and it didn't quite make it through governance for a few reasons. But I think one of them was it opened up a few larger questions about what they should be doing with the surplus buffer and how they should be structuring stuff. So it had some support, but probably not enough to quite get through. So there is a different question here about alignment of interest and stuff like that, because we're in this situation where all of the early adopters are basically saying self-custody, your own responsibility, it's your own, you should take full responsibility for your own stuff. That's kind of what crypto is about a lot. Whereas if you insure the protocols, then the users are effectively passing that on to the protocol, and the protocol is responsible for keeping them safe, and that puts liability on protocols, and how does that work? And it's all a bit mucky. So, you know, I totally like the idea, but it's not as simple as going, yes, let's go and turn it on. And also, I think you have to, with any one of these, you're going to have to go through decentralized governance processes, which are great and have a lot of benefits, but they're also quite sticky and challenging to get through, and there's obviously a lot of different competing interests.
I always tell my friends to get on MetaMask and to get on, you know, their own wallets and all that stuff, and you know, I don't know, a lot of them just are happy with that, like you said, displacement, I suppose, or shift of risk onto basically somebody else. Now, in my current setup, I do have funds on centralized exchanges or centralized, like a Celsius or Nexo, etc. Now, please don't hack me, guys. And then also, you know, in your own wallet. So I think there's a happy medium. But yeah, when those parties collide, they don't seem to understand each other when it comes to like the governance, or well, when it comes to like their thesis. And then in the governance, what tends to happen from my experience is the early adopters are the ones who have money, and these guys are kind of new. So the early adopters really shape the protocols early stages, and honestly, like all the way up to like your first few years. Like your early adopters are like basically your board of advisors, if you will. Like they are like the team. You know, you've got the team that's doing all the work and the developing, but the early advisors or the early adopters are contributing. So curious, I guess, on that note, you know, what was that process like with the Nexus Mutual? You know, how that name come about? Let's talk about that meme. What early adopters started that meme? You know, how did this community form in the early days? And yeah, just I would love to learn more about, you know, that process.
Yeah, I mean, honestly, I have no idea where those memes are coming from, but they do give me a little bit of amusement every now and then, that's for sure. But I think one of the things that's interesting about our particular community is I think we're doing quite well at fostering a long-term focus group, which is actually really key to our success. If you actually think about insurance, right, if you are short-term focused, it makes no sense at all to pay any claim whatsoever. But if you are long-term focused, it makes complete sense to pay every legitimate claim, because otherwise you would never sell any more cover in the future, right? So it's going to be really key for us to attract long-term people. And
is that because you get, so when you pay for a claim, you obviously lose some money, is that correct? But then through the payment of the claim, you then get more rewards in the future. Is that, or am I missing?
Well, no, because if you pay the claim, that gives confidence to future users that you will pay claims in the future. If you don't pay any claims, then you don't have a business. So like they're the kind of two ends of the spectrum, right? Obviously you have to do it in the right way, but like if stuff goes bad, that's when insurance companies are supposed to step in. And if they don't step in, then might as well not even be there. So, you know, but that alignment comes when everyone is more long-term focused. And so that's obviously a bit of a challenge with everyone in crypto, a lot of them being very, very short-term focused. And so we've spent a lot of effort trying to cultivate and filter for the right type of community, because maybe that doesn't, maybe that doesn't mean number go up in the immediate term, but but it means that we're going to be building a much more sustainable community. I guess perhaps this comes from me and my background, but also building through a bear market for a while, and knowing that another one's going to come, and we have to be able to make it through that as well. So that type of approach.
Yeah, I was listening to a Bankless pod. That one was pretty dope. They're talking about how in bear markets fundamentals are born, and in bull markets all the narratives are born. And so I think you hit it on the head in the sense that y'all were building bear market, so y'all know what it takes, if you will, to build throughout another one and through a bull. Sure, maybe like the marketing gets a bit different in the bull market, but like everything else is still just build. Yeah, so I think that's a good foundation to have. Yeah, I am honestly like pretty flabbergasted right now. Rob, do you have any questions?
No, I mean, this was super cool. I think we hit on a lot of good topics, ranging from security, personal, and ecosystem-wide, as well as Nexus Mutual, right? And kind of the new upgrades and new features coming out there. And governance, right? Which is really just the highest level of, the inner workings of a lot of these protocols. Super cool. Like, we could take it in so many different directions, but we've been going at it for 45 minutes, 50 minutes here.
Yeah, let's close it off with some quick questions, eh?
Yeah. What do you got, Andy?
This one might be a little bit longer, but Hugh, what is what's your why, man?
What's my what? Sorry.
What's your why?
Yeah, basically providing cover to people that can't access it. I've traveled through Peru, saw earthquakes devastate a whole bunch of people that just a basic simple insurance product would get them back on their feet really, really quickly. And regular insurance markets can't access that stuff very easily. And so I guess crypto is another one where the insurance markets don't access it. So that's good.
You got to bank the unbanked. You stop banking the bank so much, world. God damn. Good one. Rob, do you have one?
Yeah. All right, so on the horizon, Nexus Mutual, can we expect insurance on real-world events, earthquakes, hurricanes, tsunamis, anytime soon?
I'd love to do it. Priorities are probably more crypto space for right now, but if someone comes and says, I want to buy 50 million of earthquake coverage in Mexico, I'll do it. It's fine.
Would you invest in a protocol that was trying to do that?
I don't know, potentially, if they're doing it the right way.
All right, Rob, let's get the pitch going. No, yeah, I like that. I think the expansion to real world is key. My next one is what is the bridge to real world with Nexus? How do you take Nexus from crypto degens to 1 billion users?
Yeah, we think it's the most opportunity is probably likely going to be coming from the more risk-aware people. So whether that's smaller institutions or larger institutions or something like that, that's going to be one route. But then it's more going to be accessing different communities where they're underserved. One particular example I do throw out there a little bit, but I think it's quite pertinent, is like marijuana growers in Canada, right? That's a big industry, or anywhere, but they can't get banking or they can't get standard insurance just because the reputational risk, the providers don't want to take it on. But they shouldn't, that shouldn't be the case. And so it's just a big example of a large chunk of economic activity that can't get served. And so if we have a different, we're looking for distributors or people that know that type of community, those products that they need. And if they want to come to Nexus, then we can build the product pretty quickly and give them something that they want.
Yeah, you're almost saying we'll go where other people aren't, so thereby we'll take more risk. But it's a new world that we're kind of growing into, and so the risks and the thought process, yeah, as you said, is different. It's pure disruption.
But Andy, you know what? That's to the benefit of Nexus Mutual, right? As you guys take on more risk, you have a more diversified product, and the risk is spread thinner. So
wow, it's like a DeFi flywheel all over again. 2020, that was the narrative. Flywheel, bro, it only goes up. How do you feel about that, Hugh? That's one of my last ones. Tokenomics speaking wise, Ponzi-nomics, if you will. I mean, what do you think about the flywheel effect, and how does it end, I guess?
I think fundamentally it's really powerful. Like, you need to bootstrap liquidity, you need to bootstrap something so that the protocol is more useful to regular users. So at the crux of it, underlying, there's some really powerful stuff there. I think it's been dialed up to 11 when it should be down at 3, but but I think there's fundamentally some good stuff there. But as with everything, everyone pushes it a bit hard. There'll be a burnout, and then we'll find a good level.
Amazing,
awesome. Cool,
amazing stuff. Well, great. This was an awesome podcast. I really enjoyed this one. So for all the listeners that are still with us, thank you so much for being here. You guys really make this possible. We are extremely grateful to have you on as well, Hugh. It's a great start to the day for us here in the States. Thank you so much, and this was a pleasure.
Yeah,
cool. Thanks for being on, guys. Great to be here.
Thanks for listening to the DeFi by Design podcast. Until next time, DeFi Slate Team.